Good morning. Thank you all for joining this brief presentation. There's been a lot of buzz about cost segregation, especially since the passage or enacting of the Tax Cuts and Jobs Act, especially with the increase and expansion of bonus depreciation. So I wanted to provide a brief overview of cost segregation 101, if you will, and the benefits for commercial property owners. This is really going to be a 30,000-foot view, not really get into the Section 179, Section 178, or Section 263A, but those we can cover that in later segments. This is really just kind of a brief overview so that people better understand what cost segregation is and how it applies. So our objective is to cover real versus personal property, straight line versus accelerated depreciation, and then discuss cost segregation studies and methodologies, the 2017 Tax Cuts and Jobs Act, and bonus depreciation and the benefits to commercial property owners. I will cover Section 168, partial asset disposition, because that's something that's often missed by commercial property owners. And then wrap it all up with the bottom line, the economics and compliance of cost segregation. So for tax and depreciation purposes, commercial property may be broken into real property, including concrete foundations, structural framing, doors and windows, and personal property, which is basically will include everything else. The IRS allows personal property to depreciate at a much faster rate based on their usable, depreciable class lives, whether that's 5, 7, or 15 years. Now, property owners and tax professionals commonly straight line depreciate an entire property because they simply don't have the ability to economically segregate all building components into their proper class lives and values. Now, straight line is certainly easier. However, you lose the ability to reduce current income tax liability, thus the ability to immediately increase available cash flow. You lose the advantage of time value of money, which is basically money now is certainly worth more than the same amount at a future date. As assets are replaced, double depreciation of those assets may accumulate. So you don't want to continue depreciating assets as that have already been replaced. And then finally, you have no record or building system valuation for future capitalization and expense decisions, which is important when ratio testing for significance in compliance with the 2014 tangible property regulations. Now, we're going to cover the TPRs today, but just note that that's one of the challenges with straight line depreciation. So the solution, a cost segregation study, is performed for the purpose of segregating personal property from real property, typically reclassifying 25 to 50% of a building as personal property. Individual units of property may then be placed into their proper class lives, therefore accelerating depreciation over 5, 7, and 15 years rather than 39 years for commercial property, or 27 and a half for residential rentals. The bottom line is a cash flow equivalent value of 6 to 10% of the property's cost. Now, a quality study should identify and break all property down so proper deductions may be applied by your tax professional. The IRS in the Cost Segregation Audit Techniques Guide, Chapter 3, identifies 6 cost segregation approaches. The first 2 are detailed engineering approaches. In general, a cost or a study by a construction engineer will be more reliable than one conducted by someone with no engineering or construction background. They also, in Chapter 4, identify what a quality cost segregation study is. And a quality cost segregation study is a study that is both accurate and well documented. A quality study will contain a number of characteristics which are set forth below in the 13 principal elements of a quality cost segregation study, with number 1, preparation by an individual with expertise and experience. So ultimately, engineering-based cost segregation is not only a methodology, but a degree of certainty, as it uses competence in design, construction, and estimating procedures along with cost documentation when available, accounting and tax law specific to tangible property regulations, thus a more thorough approach beginning with a physical site survey of the specific property in question. So when we put this together, particularly with the recent changes, it's very valuable to commercial property owners. Because the Tax Cuts and Jobs Act, we now have 100% bonus depreciation. Now, this bonus allows for a 100% first-year deduction on qualified property acquired and placed into service after September 27th of 2017. It was expanded to include used property as long as it is new to you, as well as new property. Now, the importance of used property, again, when you purchase used property, it's very difficult to identify and separate and break out all components of that property so that they can be placed in their proper class lives. The bottom line here is a reduction in your income tax liability, generally equivalent to 6 to 10% of your property's cost, now taken in year 1 versus taken over the 5, 7, and 15-year accelerated depreciation. So if we're looking at the tax savings difference, in this example, we'll utilize a $3.1 million basis for an apartment complex purchased January 1st, 2019. With a straight line method, since this is a residential rental, it's a 27.5 year. So your annual deduction is $113,000. With the standard accelerated depreciation with proper 5, 7, and 15-year class life allocation, you more than double the amount. But with bonus, the difference is $636,000, which saves the owner an additional more than $250,000 otherwise paid in income tax, which may now be retained, invested in the business, invested in other investments, or used to pay down interest-bearing debt. As I mentioned, I definitely want to mention Section 168, partial asset disposition, or PAD, again, because this is often missed deduction and maybe misunderstood. But basically, partial asset disposition takes place when a property undergoes renovations. And as a result of those renovations, some property will be disposed of. Now, the undepreciated portion of the property can be written off. However, this must be taken in the year it occurs, otherwise you lose the ability to write it down. Therefore, you can no longer take it retroactively. Furthermore, it may not be taken in the same year that it was purchased or placed into service. So let's take, for example, a hotel that was purchased in 2018 for $7.5 million. Then in February of 2019, the owner begins a $1.5 million remodel to be in compliance with that specific hotel franchise. The undepreciated portion of that disposed property can be written off for 2019, the year that it was disposed. Then you also have, of course, the new property, which bonus depreciation now applies. The bottom line, again, here is time value of money. money now is better than the same amount in the future. Why? Because you can invest that money. Okay, using a rule of 72 at a conservative 8% interest, you should be able to double your money, the money that you saved, every 9 to 10 years. Otherwise, I suppose you would rather the government invest your money. Ultimately, who performs a study for your benefit is your choice. Just understand that all are not created equal. I like to say that heart surgeons and family physicians are both doctors, but you wouldn't want your family physician necessarily performing your heart surgery. I hope this helps. I appreciate everybody who attended this morning. Should you have any further questions, feel free to contact me, and have a great day.